Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. Today I have a very knowledgeable guest, Mr. Bruce Mack with Platinum Trust Group. Welcome to the show, Bruce. I appreciate you taking time today.
Well, Sakar, thank you so much, and it's a pleasure to be here. I'm looking forward to it.
Awesome. So Bruce is a licensed financial advisor with Platinum Trust Group. He is a very well-known, nationally acclaimed speaker. He has shared stage with the big who's who, Mr. Donald Trump, Mr. Al Gore, and some of the very known national experts. He has a veteran background. He's a financial licensed CPA. He has done active real estate for decades. He has done and flipped over 160 properties and has been involved in almost 100 million worth of active real estate transactions. So boy, it's a pleasure, Bruce. It's a dynamic and a dynamite resume. I appreciate you taking time. Give our listeners, Bruce, some background in your own words as to how you got started and now you're with Platinum Trust Group, how you kind of came about with your immense success.
Okay. Well, first of all, again, such a pleasure to be on your show today. I got started, I guess, way back when. I've always kind of had an entrepreneurial spirit. When I was 8 years old, I got started in business. You know, they always say you find a need and you fulfill it, and you can create a successful market. So the need that we had in our market was to get rid of all the dog poop on the neighbor's lawn. So I created a dog duty service, and I charged a full 25 cents per client. And before I knew it, I had a very large market share, and that was the beginning.
No kidding! Wow.
The beginning of my working history when I was 8 years old.
Interesting.
Spin things forward. I was a corporate executive recruiter for around 20 years. Had several offices, and in the financial services arena, as a banker, I was responsible for roughly 150 people. In the merchant acquiring services area for one of the nation's largest banks. And then I decided, you know, it's really time for me to go out on my own, to work with people one-on-one, and to be able to help them to be able to realize their financial goals and dreams, so I could quite literally change their financial future, because that impacts me when I'm able to serve and help them. We created a licensed and bonded credit repair company, and I tied that into our value proposition of helping people out who are in financial distress. When I was living in Las Vegas, where we was able to buy, rehab, and sell over 160 properties, saving people from completed foreclosure, giving them relocation assistance, giving them credit repair, and helping them get their lives back underneath them so that they could move forward.
Interesting. Was that, Bruce, the time after the 2008 sort of the crash, and a lot of people were needing, whether short sale assistance, mortgage assistance, and, working with banks and things? Was that the crucial 2009 through 2012 period?
This is actually in the 04 through 09, 010 area.
Interesting.
Yeah, it was really that in that span of time.
I see.
And I was also working as a licensed financial advisor with people, advising them on different ways to protect themselves so that they didn't end up like so many of the clients that I had that had gotten lawsuits, had had bad things happen to them, and unfortunately ended up where they were in deep financial, what I call kimchi.
So tell us about, how you decided to pursue a financial advisor certification, Bruce, and how's that important and closely correlated to how you serve clients from a financial structuring, restructuring, or different things or strategies that you have. How does that come into play? Could you maybe help us understand that why a like a CFA certification and how closely that license is tied to helping the clients?
Well, as a licensed financial advisor, I work with people now on a daily basis. I've actually got licensed way back in the 90s and have tried to incorporate with all of my relationships the ability to advise and help people to be able to help them with their present financial situation so that they had a better future financial situation. I was doing that and had done that successfully with all the people that I helped that were in pre-foreclosure. And then we started to really move away from that model when I moved back to Los Angeles and started to work with people in the trust arena, getting them set up so that they had their entrepreneurial selves, whether they're dentists, doctors, lawyers, what have you, or real estate investors, which is a very large segment of the folks that we work with, to be able to protect them from an asset protection standpoint and to also work with them from a tax mitigation standpoint so that they were on an annualized basis paying as little as possible and saving them tons of money on that particular piece of the equation, along with giving them the absolute assurance that they could not get liened or have a lien or a judgment affixed to them where they would be paying out of pocket and end up financially devastated after creating and the underpinnings of great wealth and or their startups. So that's what we do today is work with entrepreneurs, helping them and giving them the absolute asset protection that they need and the tax mitigation strategies relative to the trust mechanism that we've got, which is a proprietary and copyrighted trust. We actually have 28 copyrights on the trust, and we've gotten the trust copyrights going back to 1996. We have 31,000 clients. We have over a 20-year track record. I even have people who are enrolled agents with the IRS that work with us with the proprietary trust, and it's just been a wonderful, wonderful experience to work with folks and helping them get their, if you will, get their entity structuring properly, getting them out of LLCs, which don't provide the asset protection that it does, and getting them into the trust mechanism, which is the ultimate environment to protect them. Just like it says in my book that's coming out in the next several months, The Kennedy Equation, which talks about how the Kennedys, the Rockefellers, and the Carnegies were able to create generational wealth and not have to worry about being sued because they were insulated against liens and judgments coming after them and taking down their empires, so that they could focus on money and wealth building strategies to be the entrepreneurs that they got to be. And we take that, distill it down, and show people how using that trust mechanism can take their today mid-America for everyone utilization of taking a trust and implementing it for their financial future.
Sure. Thank you, Bruce. There is, so much that you said and so much to unpack. There are a lot of good nuggets you talked about, asset protection, how you structure your trust. Let's take it step by step, Bruce. Like for someone who doesn't understand or hasn't seen the details in between, how the assets have to be properly structured and protected so that, as we all know, like There are a lot of lawyers and bad actors out there, pretty much snooping to kind of see where they can, find someone, whether into a negligence or, just trying to lure somebody into a lawsuit of sorts, right? And we all have seen it in the news and, media, newspapers, all kinds of outrageous headlines, right? So help us understand that why asset protection, especially for, larger real estate investors who have multiple properties and multiple, so much of exposure out there. Help us understand how does, why asset protection, and perhaps sometimes I feel that a nice way to look at it also is that look at some of the bad cases or the case precedents, as we say it, right, that may have happened. And sometimes that acts as a lesson that, hey, such and such thing happened to someone, and hence it is advisable to use some of these strategies. So give us some examples, give us some idea as to how asset protection has to be structured properly within as you're organizing your business.
Very good question. Thank you so much. So let's start with the fact that Cs, LLCs, and Ss, plain and simple, though you may think so, they really don't protect you. And the fact is, when we work as solopreneurs and are member managed on our LLCs or partners, because it's you and your wife or you and a business partner, you still have what's called a closely held entity. And one of the easiest ways to be able to pierce the corporate veil, and there are several different ways to do that, but one of the easiest ways is to allocate alter ego, which can be easily proven because when you have that closely held entity instead of 50, 100, 500 people, it's easy to prove, allege and prove the fact that you are operating, well, like you're a puppeteer. And like the puppet that you are being the puppeteer to is you. And you're pulling the strings, telling yourself what to do. And therefore, you've really created a facade for controlling the shareholders, which again is you. And therefore, it's an easy argument, let alone the ability to bust into a LLC, a C, or an S, utilizing the fact that you have not exercised the proper corporate governance. We find that roughly 50% of the cases that allege that the person has not kept the right corporate governance, having the right meetings, the right minutes, the right payment to the entities at the right times, those can also be broken into. And once you pierce the corporate veil, of course, any and all assets can be gotten. Another unfortunate misnomer is the fact that people think that if I have one LLC for each property, I'm safe. I'm here to tell you, I can cite case after case after case where they've gotten one and therefore they've been able to get all LLCs.
Wow.
So LLCs, by the very nature of what they are, I mean, I have one unfortunate, they're not a client of mine, but they're a client, they're somebody that I know that they are now. They had 140 properties and 2 commercial buildings. They ended up losing all of them, and many of those were in separate LLCs. So this notion of one LLC for one property, I'm going to be safe. The worst I'm going to lose is one LLC. Well, first of all, that's nuts, because why would you want to lose one LLC? One property, which could be hundreds of thousands of dollars worth of equity. With a trust, this cannot, will not, and does not happen. It's an absolute, that's why we call it absolute asset protection, by implementing the right type of trust structure, which is the type of structure that we've got. And Lord knows there's many, many different types of trusts out there for many different types of reasons with many different types of structures. But the type that we've got absolutely assures our clients of absolute asset protection.
And we will get to, learning the details about your trust structure and what the advantages are, Bruce. I'd like to know, You mentioned the best practices, the meeting minutes, and different notes that you have to keep on an ongoing basis, right? A lot of listeners of our podcast are, extremely busy professionals. Sometimes they are passive investors many times, or even the active syndicators and real estate investors, right? In your opinion, what are some of the things you can advise us from a operations perspective, from a best practices perspective, as to what things like investors especially should record on a probably a daily, monthly, or quarterly basis, so that these unfortunate occurrences that you said will not happen, or even if certain inquiries come to fore, we can produce some of that data and the ledgers. Could you maybe give us some pointers regarding that?
Sure. Well, here's one. One of the common mistakes that investors make and or other business entrepreneurs make is they'll utilize their credit card statements for their backup for filing their taxes. And unfortunately, if they were to get themselves into an audit, all of that could be thrown out, and therefore all the expenses could be disallowed. Now, we happen to have a system that we work with, and that's one of the things that we give to our clients, that automatically creates daily, weekly, annual reports, so that you can take a picture of the receipt and it paginates it to the cloud, and it automatically does the classification process. So if ever you were in an audit, you'd be assured to be able to win that audit. Not only that, there's another component to it that automatically tracks mileage through a GPS application that we've integrated with this particular system. So imagine that you're leaving your house and you're going to see a seller or a buyer at a property. You just click a button, you make a audio append, and then that automatically begins at 15 miles an hour to track your exact route. So again, you have an absolute audit proof scenario where you cannot and or will not get called on the carpet, because your records are in perfect shape, and having good records is key. Also, one thing I do want to say, that with a trust versus an LLC, a C, or an S, all those records that we were talking about, the meetings, the minutes, and all the corporate governance that you have to have, and the tax returns that you need to have for each LLC, not only is it mind-numbing, but it's also extremely expensive, especially if you're in California. It's $830 to the Franchise Tax Board for each LLC, and usually about $1,000 to do, regardless of where you are, to do a business return for each LLC. True. One of the great things about the trust is there are no annual filing requirements or fees or ongoing types of requirements that have to be fulfilled on a daily, weekly, and or annualized basis. So it streamlines the whole event, it simplifies the whole event, it makes it a much easier way to contend and to administer and administrate over your entire portfolio.
Right. Thank you. Thank you for all that detail, Bruce. Now, explain us, Bruce, as you alluded to, that your company owns a, proprietary copyrighted trust, right?
Yes.
So let's maybe dive into some of the basics of the trust, as to what are the different types that are available, and then perhaps how your copyrighted trust is sort of different and provides all the benefits that perhaps may not be available with other trusts. Could you maybe help us gain some understanding into that?
Sure. Well, having been involved with trusts for well over 2 decades, I can speak with impunity and with a high degree of knowledge, and having seen quite literally hundreds and hundreds of trusts, and having staff that's on board that we have legal people, and this is what they do. They research what's out there, and and have become quite proficient at knowing what's out there and what's not out there, and so on and so forth. One of the key differences that I've seen with our trust is not only do we offer absolute asset protection that most trusts don't, and the trust that most people do have is what's called a living trust. And as it suggests, it is a grantor revocable trust, and it's the basic trust that, again, most people have if they have a trust, and it only is good for two things. Number one, for being able to avoid probate, and number two, for naming who the beneficiaries are. And if that was the intent for the trust, great, because it's fulfilled with that promise. But
sure. Now let me interject, Bruce, that you said something there that grantor revocable trust.
Yes.
Right? Could you maybe help us understand what that means? And also, you brought up probate. Help us understand the probate side of things as to why trust should be there and why you want to avoid probate. Give us some preliminary basics on those few terms there.
Sure. So let's talk about probate for a second.
Sure.
A reason that basic trust that so many people have it is, first of all, it is an entry-level trust and does give people the ability to avoid probate. If you don't have a living trust, you will invariably, your estate will go into probate. And when it goes into probate, it could be tied up for, quite literally for years. Probate is something that that estates get headed for if they do not have at the very least, a living trust. And probates can go on for years and years. I actually, my aunt had an estate. I got a few $1,000s. And unfortunately, that estate was in probate for 15 years. The other problem with a probate is that there will need to be a trustee named, and that trustee, to get paid, takes a portion of the actual proceeds of the estate. Oftentimes, it can be 10 or more %. So not only are you losing your estate value, but you're also losing time in getting distribution to the people who you wanted to get the distribution to. So one of the things that we've incorporated in our proprietary trust is the fact that you are never going to, because of the way it's set up, you're never going to have to be worried about and or go to probate. Now, you also asked a question about grantor versus non-grantor.
Sure.
Self-settled trusts are grantor trusts by the very nature of what they are. And being is that they are self-settled trusts, they cannot, and will not have the ability to have tax mitigation because there is a requirement that self-settled trusts file and settle their taxes at the estate tax level on an annual basis. So that's one thing. Also, the difference between grantor and non-grantor, relative to our trusts and most trusts that are out there, when you get into a grantor trust, you cannot invoke the irrevocability and spendthrift provisions, which are other provisions that can create an extremely strong bond for getting absolute asset protection. So again, our trust is not one component, it's a multi-componented trust, but non-grantor versus grantor means that the individual is the grantor themselves, therefore it becomes self-settled, and therefore it does not and cannot provide asset protection, and let alone potential tax mitigation.
Sure. So thank you, Bruce. And you've been kind enough, Bruce, to help us with a webinar talking about a lot more in-depth details with your trust. So I'm hoping the viewers can take advantage of that upcoming webinar. We are hopefully with a short few weeks away, depending on the schedule, depending on your schedule, that we will host that webinar where we'll delve into the copyrights, the salient benefits of your trust. Give us some, for starters, Bruce, that what are so significant benefits of your trust that you were sort of inspired and motivated to, and you have devoted so many hours and efforts to get this thing established. And you also alluded to at the start saying that you are working with various IRS agents as well on the different ends of this trust as well. Give us some, for starters, give us some background as to how this came about.
Well, the trust came about way back in 1996.
Mm-hmm.
It is a derivative, and we use some of the foundations and the building blocks of the Dynasty Trust. And the Dynasty Trust is the trust that the Kennedys have had from a generational standpoint. And where our trust really diverges, if you will, from all other trusts that I've seen is there are other trusts that can afford and do provide for some asset protection. And some of them are certainly better than others. And not only do we have asset protection as one of the key precepts of the trust, but we also have a tax mitigation component pursuant to 643 of the IRS tax code, which is unlike anything else that I've seen in all the trusts that I've reviewed over the years. And other trusts can't have it, again, because of the proprietary way that we put it together, where we enjoy those 58 copyrights. So what are we talking about? Well, we're first of all talking about the ability to defer in perpetuity, all rent and lease income. So if you are a real estate investor and you've got rents and lease monies coming in, we get a tax deferral in perpetuity on that and eliminate all capital gains, whether it's short or long-term capital gains.
Wow.
Incredible too.
Unbelievable.
This way, there's no 1031 exchanges ever needed, because a 1031 exchange, of course, you're going to get a bigger tax bill when you sell that last property and you want to cash out and maybe go to Mexico and sip pina coladas on the beach. So this is huge. Now, if people have W-2 income as a portion of their earnings, which we have a lot of real estate investors who also have a day job, right?
Sure.
That W-2 income portion, we cannot do any mitigation with. So, or if somebody's strictly a W-2 income earner, then the tax mitigation component and the deferral component does not apply. But for real estate investors, which have all of their income is considered to be passive income, whether it's lease and rental, or whether it's long or short-term capital gains, we can be a huge benefit for that person with the tax deferral component. And this is also great for people who own businesses who have active income. So let's say you own a car wash, you're a doctor, you're a lawyer, you're whatever you are, or you've got a brick and mortar, maybe an internet business. That's all considered to be active income. Again, we can get those types of businesses, and consistently those types of businesses, when we get them set up, receive excellent tax deferred capabilities with their trust once it's set up.
That's extremely powerful, Bruce. That I have never heard of such a thing, where you are, I think, deferring your rental income, and because we work so hard to make sure, we are like accounting for all the details of depreciation, we can write off as much as we can. But sounds like if the properties are structured within your trust, you are inherently enjoying those benefits and deferring that. Wow. I mean, could you help us, give us some details around that, Bruce, as to how it works? I mean, like you just said that all the rental income, leases, and even the capital gains also you can defer. Give us some a bit more details on that, please.
Well, with real estate investors, and that also transcends into stock market investors, and passive income is passive income, whether it's Forex, whether it's metals, Bitcoin, whether it's a stock portfolio, whatever. It's all lumped into that same basket. If you're not doing something actively to generate income, and it's coming to you passively, then it's all passive income. It would need a singular trust. And we are generally on an annualized basis, our clients are receiving versus their old way, I'll say it that way, versus the old way, they're seeing usually a 95 to 97% reduction on their annual tax commitment, which is huge because the rest of it becomes deferred out in perpetuity. Now, if they have an active business, then they will need a two trust business structure where they would have a business trust and they would have a beneficial trust. And on the business trust portion of their income, let's just say they are strictly a dentist. That business trust, they're going to see about a 78 to 80% deferral on their income. However,
massive.
We have many dentists or people with active income businesses that also have a passive income that they receive from their stock market investor activity or real estate investment activities, in which case they still get the 95 and 97 on those activities as well. So it's a incredible savings for the person on an annualized basis, because we're kicking that tax can down the road, usually 100, 200, 300 or more years, and it will not affect any of the beneficiaries and or the beneficiaries' heirs. They will not have the tax responsibility either.
So does that, upon death, Bruce, does that like basically extinguish the tax liability? Because
No.
A deferment is different than sort of forgiveness of sorts, right? So I mean, how does that work? Like, how long can you defer? And let's say if the if the owner of the trust passes away, does that liability that's basically deferred, does that kind of go on to beneficiaries, or help us understand some of those aspects?
Sure. As I stated earlier, the way that the trust is written is that the taxes are deferred in perpetuity. So we need to understand what the laws of perpetuity state. And they basically state, I'm going to how can I say, simplify it. Talks about life and being, but basically the owner of the trust, which invariably is going to be the trustee, which is invariably the client, right? The initial client, they've passed away. Their spouse has passed away. Their beneficiaries have passed away, which are usually their kids, right? And their beneficiaries' heirs have passed away. And then there's a period of 21 years that goes by, and then the trust distributes. So again, this could be 100, 200, 300 years from now, because when we take and we apply real life to it, well, when the mom and the dad pass away, and then the kids become the contingent trustees, and they have kids, and those kids become beneficiaries, and so on and so forth. You can see that this rolls forward and keeps going on, and it's truly what we call a generational trust by design. And when it does distribute, nobody that's ever associated with the trust from a family tree standpoint, directly or even indirectly, would have the responsibility of, if there are any taxes that have accrued that would be due and payable at the time that the trust distributes. And that, of course, was done by design when the trust was created. And it's
very interesting,
really brilliant.
Yeah, I know. I mean, I appreciate your time, Bruce, because, and you have also candidly agreed to do a detailed webinar on this. So I want to encourage viewers to look out for, the notifications and the marketing around this webinar. And I'm excited to, kind of host you. And also, I want to thank you that you have also agreed to prepare a lot more detailed notes and give viewers the slide deck around this so that they can take some advantages as well. And I know, Bruce, you stated that your company also does some creative lending other than some of these practices. Could you maybe give us some examples about what sort of lending you do and how you help investors?
Absolutely. Well, first of all, I want to tell you, when we first jumped on, right before we started the podcast, you asked me, would I be amenable to coming back in a couple of weeks and doing a really roll up your shirt sleeves workshop where,
absolutely.
where I jump into great detail and go through and have slides prepared to show how the trust works in greater detail, which I'm delighted to do and I look forward to doing. And I think it'll be a ton of fun and it'll get a lot of great information out there for your listeners. And also because we're giving them a heads up today, they'll be able to prepare to be able to watch the video portion, not just the audio portion, because there's a lot better absorption rate that way.
Absolutely. I couldn't agree more.
And then secondly, to answer your question about our what else we do, we have another division. We actually have two companies. One is Platinum Trust Group, which you can find us at, and there's some information there too at platinumtrustgroup.com. That's platinumtrustgroup.com. And the other division is our Platinum Financing Group, which can be found at platinumfinancing.group.com. Both companies are rated by the BBB. We have an A+ rating. We've never had any complaints. So knock on wood, we will keep it that way on a going forward basis. Our financing company does work to try and evoke creative financing solutions for people. We have startup capital. We have capital infusion for existing businesses. And we have a number of different programs. One of our premier programs is our 0%, let me say that again, 0% APR program for up to 21 months. That's been a huge success for our clients. We also have private money investors and hard money lending. So whether you're doing SFRs, single family residences, or multifamily or commercial, we invariably, if there's a solution out there, we've got that solution, and we're delighted to talk to you about it to see how we can get you funded for your next project and or next business idea.
I'd love to dig into those topics. It's just that we are out of time, Bruce, and I would request that if on our webinar, if you can maybe spend 10 more minutes giving us some financing solutions as to how you help various investors as well, because I think 0% APR for 21 months is extremely lucrative, where I can see that a lot of flippers or retail projects that investors execute, they sometimes need 6 months to a year at the most, but if someone is offering you 21 months, boy, I mean, does that open a lot more possibilities for all our investors for sure, So I appreciate your time today, Bruce, and as I encouraged all the viewers earlier, look out for the upcoming webinar. Tell our viewers, Bruce, how they can get in touch with you.
Sure. And by the way, I will make sure, this is my promise to you, Sakar, I will make sure to add in several more slides to the presentation that will cover financing, and we'll show you some of the separate programs. We've got a killer program for people who have IRAs or 401ks that beats the pants off of a standard self-directed. So you'll definitely, if you've got an IRA or 401k, if it's in currently a self-directed environment, that you have very limited options, because you can get charged with doing self-dealing, which of course automatically can blow up your whole self-directed. We have a solution. We'll talk about that solution on that upcoming webinar. I'll add some slides in about that as well.
I appreciate that.
As far as contact, please feel free again to go to www.platinumtrustgroup.com.
Thank you. I appreciate your time today, Bruce. I look forward to learning more from you on the upcoming webinar. It's been a pleasure, and I think sharing your experience from decades and having your innovative solutions does provide a lot of value to investors. So it's been a lot of fun. It's been my pleasure to have you. Thank you for your time today.
Thank you so much. And look forward to the upcoming webinar.
Thank you. Thank you, Bruce.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.